Welcome to Something More with Chris Boyd, certified financial planner practitioner and founder of Asset Management Resources, LLC, a registered investment advisor firm. We call it Something More because we like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients across the country, your host, J. Christopher Boyd.
Everyone, thanks for being with us for another episode of Something More with Chris Boyd, and I'm here with Jeff Perry. And I want to remind everyone, if you are still listening to us on the radio, you can listen to us on our podcast probably sooner. We put out our podcasts usually on Fridays and Mondays, and we'd love to have you join us and become a follower, rate, give us a star rating and maybe a
comment.
Review. Comment helps other people find us, and you can find us for podcasts wherever you like to listen to podcasts. We're posting on Spotify and Apple and Amazon, Google, wherever you go.
I'm hooked on podcasts. I just download what I download, and then when I'm out for a walk or when
what I'm interested today, you scroll through your options. Yeah.
Absolutely. On my schedule, right? I mean, that's the beauty of it. I don't have to. It's funny, you think about it. You used to have to sit by the radio if you wanted to hear something, or turn the TV news on, sit there at 6:00 or whatever your routine was. And now it's more and more things are on your schedule. Oh, I'm going to DVR that. I'm going to listen
on
to
demand.
The podcast.
Yeah. Love that.
How did we survive before?
So much better. And also, we're posting on YouTube if you prefer video content as well. So
with you and I on the show, I'm sure they prefer video.
Prefer the video, right? Doubt that. But okay. So anyway, well, thank you for letting me just mention that. And this segment, we're going to talk a little bit about newsworthy happenings and some of the issues that relate to our portfolio and thinking about investing and as it relates to what's happening in the world around us. And with that in mind, there's plenty happening in the world around us, Jeff. I wasn't really intending to start with, the world events, but we continue to see war in the Middle East, Israel's response to Hamas. The attack a few weeks ago, and then Russia's attack on Ukraine and the continuing war over a year into that, and it's as we talked about in other occasions, there's always the anxiety as an investor that everything will amplify and magnify, and so the more Middle Eastern countries will engage in war, and that may overflow to war with Iran because they're supporters of Hamas, and Iran has ties to countries like Russia, which has ties to China,
North Korea, and
you get into all this kind of like imaginings of this escalation of world tensions, which no doubt is to some extent a concern. But it's not the present concern. It's not the likely outcome. We're not, I don't want to say definitively that we're not on the verge of World War III. It just seems we're not there today. There's a lot of progression before we get to that. And how do investors make sense of that, Jeff, when it comes to thinking about, what do I do? Should I be taking less risk? Should I be putting more money in a mattress? Should I be buying gold? Whatever it is, all the things that that play on people's fears, that oftentimes are a response to some of these kinds of things. And you often talk about the idea that fear is not a good place to be making decisions.
No, it isn't. I think there's two different ways to look at it. If you have a financial plan that you've thoughtfully considered, hopefully you work with someone to help you with that. But even if you don't, you have a thoughtful long-term financial plan, you have goals, you have measurements, and you have history of it's time to certainly review it periodically, but it's time to ask yourself, is what's happening somewhere else relevant to my financial plan? Um, and in most times, these geopolitical events are not relevant to your financial plan. Certainly, it's worth talking about and
Yeah.
having your, but
Brian Regan,
it's
sorry, continue.
no, go ahead.
Brian Regan, our firm's chief investment officer, has often mentioned the idea that it's kind of surprising, but markets moved higher during World War II. This is something you'd generally expect. That you envision, or you can look at other periods of strife. That doesn't always necessarily equate to. You look at times and things can still do well. The economic engine that drives during a wartime can actually be productive, if you will, from the point of view of earnings, stocks, and
That's right.
growth of companies. Not that we strive for these kinds of circumstances by any means, but it doesn't necessarily equate that what you would envision as a source of anxiety and problematic times, that it necessarily is the equivalent to market decline. Now, it's frequently the case that markets will react and there will be disruption, but these aren't necessarily always long lasting. And, no one can predict what's to come when it comes to market movements and in the near term. And I'm not trying to say, oh, nothing to worry about. Markets move, and this is part of the process when you're invested. What's critical is, will earnings increase over time to make companies more profitable and investors more profitable, so that the value of that ownership interest in a company or many companies will increase over time. And I think, to your point about a plan, if you still have that perspective that over time, companies will continue to become more profitable and grow in value, despite short-term disruptions in pricing due to anxieties, one should continue to still own some portion of their portfolio in stocks, perhaps, and some portion of their portfolio in things that might be more stable, like bonds typically, or cash these days, or, we, mentioned gold a minute ago. I think sometimes this is a topic that oftentimes people think about gold as a store of value. And if you look at the pricing of gold, it fluctuates significantly. And it is not necessarily true to think of it as a true store of value. We often have these doomsday scenarios where we think about gold in the context of maybe a World War II kind of imagery in our head, where people are running for the exits, and their currency may not retain value, but their precious metals would, or jewelry or something like that. If you have that kind of a doomsday scenario, I think there's some comfort in having some portion of funds in something like a precious metal or whatever. It's not necessarily a great rate of return in all circumstances. We tend to be more tactical when we use things like gold in a portfolio, as a largely driven by what we think is happening with the dollar and how it's likely to affect the price of gold. But that's not what most people think of when they say, "I want to have some gold in my house or in my safety deposit box or whatever." And so keep it to a modest level. I mean, I think, when we talked about the idea of investing in cryptocurrencies, we had the suggestion from Rick Edelman that maybe 1% is a good threshold for people to entertain if they really want to have that, get rich quick kind of speculative possibility. It's not enough that it would do them in if it goes under 1%. But on the other hand, if you think in terms of precious metals, I would be very careful not to do more than, say, 10% of your your wealth into something that is volatile, really, and it's unclear whether it will be a good investment. It's really more of a peace of mind kind of virtue, and that can have value. It just may not be as good a rate of return potentially. It depends on certain circumstances.
A big problem with gold, as I see it, is when people are most inclined to buy it in times like this, or maybe, during the late
financial
70s,
crisis, for
early
example.
80s.
Yeah.
Right. And in times of uncertainty is when people are inclined to buy it, is the exact worst time to buy it. For
Tends
example,
to be overpriced. You're saying it's too
if you
costly.
right, if you bought gold, just to use my example of 1979, 1980, so you would think, gee, that's 40 plus years
I
ago,
think
would
it
have
was even
appreciated.
earlier than it was at its peak. I think it was I forget. It wasn't in the early 70s that it peaked?
Um, so
I
the
don't
peak,
remember.
the peak was in,
At 300 or whatever it was, that kind of range.
well, according to the chart that I'm looking at on macrotrends.net, it was in the late 70s
Oh,
that
okay.
it peaked.
All right.
But it certainly had a spike before that. But so in that time period, if you had bought gold and said, I'm going to keep it as a long-term investment,
Yeah. Took a
you've actually
long time.
lost. Yeah, but you've actually even today with the recent spike from the geopolitical events, you've lost money over 40 years.
Because of the comparative alternative, or that it's actually not?
The actual price of gold in um, September, the late 79. So I'll just pick a date here of September of uh, in 1980, November of 1980, the price of gold was $2,400 an ounce. For example, this is just a snapshot. Some might say I'm selectively picking the date. My overall point is, if you're buying it in times of turmoil or geopolitical events, it's already spiked.
Yeah. Yeah. So, I think we see a lot of things on television where,
Whether sales pitches is what you're talking about, right?
advertisers are
Advertisers, yeah.
are trying to pitch a gold as a safety net. Just be very
Uh-huh.
careful of that. And there's a lot of commissions both on the way in and on the way out. It's very inexpensive to buy gold through an ETF as a comparison, but that's not usually what people are trying to do. They want to have it in their hands, not necessarily in their investment account.
Right.
So, in any case, I got a little sidetracked on that,
We
but
did, yeah.
the
Sorry.
idea of anxieties in the market, and there are things to be paying attention to, but let's just try to encourage people, keep some perspective, try to set a plan for what's a good structure for your portfolio and work that plan as the way you invest, and be prepared when you have asset classes that have risk and volatility, which stocks and precious metals would be in that category of having volatility and risk. Be prepared to endure that volatility and risk, and that's why we don't just have one asset category. Typically, for most investors, in the process,
Right.
one of the things people often have are bonds, and that might lead us to another topic with regard to this week in the news. The Federal Reserve was had their press conference and their meeting. Jeff, do you want to talk about that?
Sure. This is where Chairman Powell comes out after their 2-day meeting at the Federal Open Market Committee, and they make a decision whether or not they're going to raise short-term interest rates. And I think most of our listeners know we've had a series of rate increases. So the Fed rate is 5.25 to 5.5. The Fed's been raising their rates to slow the economy, to slow a recession, and having some success. And so these meetings and these comments by Chairman Powell are very much observed by the markets, because one of the things that we going back to the basics there, talking about what drives the stock market. Well, it's earnings, as you said, and it's interest rates. And higher interest rates tend to have more people perhaps not look at the stock market and look for fixed rates of return, treasuries in some cases. So this week the Fed paused again, meaning they said no. The conditions of the market, the conditions of the labor market, the slowing, although arguably not slowing, economy.
Well, the thought that inflation is likely to continue to decline, though not necessarily in a steady rate. I think I think he called it clumpy or something like that. But I forget the word he used, but it was
everyone analyzes those words, right? I mean,
but the idea that it would be not necessarily in a consistent, steady pace, but it's going to happen in chunks or something like that. And so, so I think that that's a fair characterization, that the idea that it does seem to be having some effect. They're not ready to say we need more yet. There's still a possibility in December. There should be more data that's going to come out between now and then.
Sure.
And they'll be in a better position to perhaps assess whether or not they want to continue. In the meantime, though, the bond market is doing some of their work for them.
Well, he said that. He acknowledged that, right?
Yeah. And so what does that mean? The expectations previously, earlier in the year, was that the Fed's going to raise rates and then they're going to turn around and reduce rates. And there was expectation, perhaps even this year, that rates would start to decline when we were looking at the turn of last year. And of course, the Fed has made it clear that's not what they're doing. Right. And their intention is to, once they find their sweet spot, they hope to stay there for a long time. Who knows what will really happen, but that's the messaging they're giving.
Higher, longer, right?
Higher for longer. And so the market is kind of adjusting to that mindset, that they are believing that the interest rates are going to be higher for a while. And so, what we had seen earlier in the year was an inverted yield curve where short-term rates were higher than what the market anticipated would be the rates, say, 3 years out or 5 years out or whatever. Now that's changing dynamic where 3 and 5 year and 10-year rates have risen to some extent. We've seen the 10-year over the last month or two have occasions where it bumps into the 5% range. Last I looked, it was below that, 4.89 or 4.8 something. I forget what it was, but not quite there. But still relatively close to that 5% kind of number. And so what does that imply? It causes people to think about, if interest rates are higher, does that make it harder for businesses to make use of money, borrow money to expand and so forth? Does it have a slowing effect, the intended purpose?
Consumers too, right?
And for consumers, and consumption is a big driver of our economy. And we've talked about that in other instances, Jeff, where consumers are getting, have less than they used to. Brian did a good job in talking about that in our firm's quarterly webinar.
Right.
And he did a nice illustration, an example of, where we've been, where we're at. The consumer isn't as flush as they once were.
Right. Yep.
And very likely getting tapped out. We've talked about, increasing drain with the student loan issue coming back now. So, all these factors do have a slowing effect on the economy. So Fed's keeping interest rates where they are. They're continuing to sell off some of their portfolio, which also, puts more bonds into the market. That pushes prices lower, potentially yields higher. So that also has some kind of effect on the curve, potentially. And so here we are. Now that brings us to maybe talking about the Treasury, I guess.
So the Treasury, they're in charge of quite a few things, and one of them is financing our national debt, right? So we have I lost the count, 32 or 33 trillion dollars.
33 right now, something 33
right.
something, right? 6 or something.
Yep. So what that means is they sell bonds, bills, and notes to would-be buyers, right? To finance our national debt. And our, prior to the last couple of years, our payments on our national debt, although growing, were at really low rates. And with higher rates that the Fed is has been fostering, if you will,
Yeah.
and the markets responded as these bonds come to maturity and people cash them in and they go to reinvest looking for higher rates. It's costing the federal government more, and our national debt is more. So I guess the question, question is there a market, meaning are there buyers of our debt at the current rates? And because the
So the
amount of
rates
debt,
are more attractive, but there's a
right,
enormous amount of debt that I had an interesting conversation I heard on CNBC the other day. They were lamenting the fact that the Treasury hadn't chosen to extend more long-term debt during the lower interest rate environment.
right,
And of course,
kind of a Monday morning quarterback
very
situation,
much so, I had
right?
that
Yeah,
same thought. And, of course, there may not have been as much appetite for low
exactly.
or long-term debt, at very low rates. But, um,
I wasn't
sure
excited
makes
about locking up money for 30 years for 2.5%.
right, as a consumer, as a buyer of that debt,
Right,
as a investor, if you will, in that debt.
right.
Um, but at the same time, you can understand why that would have been appealing to try to make that debt less costly for longer. Probably would have been a good idea given our fiscal policy. But in any case, I think it is a little bit of Monday morning quarterback that.
Mhm.
But what does it mean? It means that our debt, a cost of servicing our debt, the cost to the taxpayer, on as part of our budget, our federal budget process. What is it, doubling over the next year or something like that?
Yes,
Does that
absolutely.
sound
Yep.
about right, Jeff?
Yep.
Uh, so essentially we have all these bonds that will mature and need to be replaced because we're not ready to just pay off the
We can't pay it
obligation.
off, right?
We're
Yep.
not we're not operating on a surplus. We're operating on a deficit where not only are we in need of kind of retaining the debt we already have, but we're adding to it. And so you have this enormous amount of debt that we're trying to fund through these treasury auctions. And of course, we've got this supply demand challenge. And, we know if there's more supply, um, that tends to make the price be a little lower. In the case the yield go a little higher. So we're looking at, you have to entice people in with higher yields. That's an issue. You were talking about, the different buyers, there's less appetite from some of the traditional buyers that have historically owned a lot of US debt, and maybe, you know, tensions in
Right.
the world is a component of that with, adversaries, even trading
Yeah.
partners that maybe say,
Yep.
maybe I'm not sure I want to own that debt in case, we come to different views on issues. Will that be problematic? Um,
China is what I was talking about. There was some articles in the news that um, China is not going to buy as much as they've bought in the past, and even if rates are higher, their economy is slower, so maybe they have less investment capital. Period. You
yeah.
know, is appropriate for treasuries, and
So
there's the general demand has been less. And one more thing to throw into that big
sure.
bucket is that we continue last year, this year, to have a federal budget deficit, meaning this year's budget is going to add
Yeah.
$1.7 trillion to the debt that needs to be financed. So
We're at
we're
a
not heading in the right direction.
I don't know about you, Jeff, but I do hear more and more people talking about the need for fiscal restraint and a greater sense of addressing these issues, that we need more and more of that. And I think that is valuable to have that be part of the dialogue,
Yep, I
so
agree, and you hear it from business leaders as well, not just the conservative Republicans who were sounding the alarm for a while, but you're hearing it from people who aren't involved in politics but economic focus people or business people or just general commentators. It's something we're going to have to deal with.
And something we'll be watching and is relevant for things we think about as it relates to how to invest when it comes to the potential dynamics of rising interest rates longer on the curve. In any case, we've run out of time for this episode. Jeff, thanks for some interesting topics in the news. Until next time, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's financial planning, portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at amrfinancial.com or call us toll free at 866-771-8901 or send us your questions to radio@amrfinancial.com.